Welcome to the Millionaire University podcast. I'm your host, Brien Gearin, with you today. And on this edition of the MU Pod, I'm joined by Charles Seaman. He's the multifamily syndication expert, and he's also the host of the Master Passive Income, the Multifamily podcast. There's a lot more that goes to that story, but Charles, I want to welcome you to the show, man.
Thanks so much, Brian. It's a pleasure to be here.
Yeah, this is going to be fun. We're going to be talking about something that is new to me, multifamily syndication when it comes to real estate and real estate investing. It piqued my interest because I think there's a whole lot that goes into this that I absolutely have no clue about. And I'm sure there's plenty of listeners out there, maybe they're even a little bit adjacent to it and they're curious about it. So this is going to be fun. But before we dive into learning everything about multifamily syndication, let's get a little bit of your origin story. How did you get to what you're doing today, and what was your path?
Absolutely. Well, what I always like to say is, it wasn't really the path I expected to be on, but it kind of, sometimes life takes you in different directions, and you got to trust it and follow the process. When I was 20 years old, I was young, dumb, and broke. That's the way I like to describe it. And I didn't really have direction in life. I was trying to figure out what I wanted to do and what my goals were. And sometimes necessity has a great way of helping you find that. So at 20 years old, I was at a point where I was working as a bank teller. My mother, who was a single parent for my entire life, became disabled, and I said to myself, okay, well, there's no way I'm going to be able to pay the bills and support her if I'm going to remain a bank teller. So I started looking at some of the options I had, and I called up a guy I knew who I was a friend of the family of. And a few months prior to that, he had made me a job offer, which I didn't really do anything with. But I called him up and I said, look, if you still have something, I'm interested. So he told me to come by and meet him at his office in New York City. And I went on a Friday afternoon, and, going there and meeting and unexpectedly training for 12 hours probably should have been a pretty good indicator of what my path there was going to look like. But that path led me down a total mindset shift because it allowed me to see different things that I never really was exposed to, different things that I never really thought of because they weren't something that was part of my universe at that time. So the guy that I worked for was a very successful entrepreneur. He started many businesses that have become successful. And I had the opportunity to work very closely with a guy who's wealthier than most Fortune 500 CEOs and to learn a lot from him. So my first thought when I started there was, okay, I'm going to be here for 2 to 3 years. I'll, kind of get myself solid financially, and then I'll go out and I'll do my own thing. And sometimes as life happens, plans change. So what happened there is that I wound up, making more money. I started getting more responsibility. Maybe I started thinking I was important. And after about 10 years, as I'm hitting 30, I said to myself, I always wanted to go out and do my own thing. And somewhere along the way, I lost that. What happened? And the place I worked at was kind of entrepreneurial anyway. So even though I wasn't the entrepreneur, it was still something you had to use a lot of those same skills and traits at. And, I started really reevaluating life, started looking at different options, took a few courses in single family real estate, realized pretty quickly that wasn't what I wanted to do, both because one, I wasn't good at it, and two, I didn't enjoy it. And then I took a step back, just continued working my job. And in 2016, that was the first time I discovered syndication. And if you're anything like me, when I think of the term syndication, I think of television, I think of the mafia, but I don't usually think of business or real estate. Uh, so what that did for me was it showed me a path of how I could do the deals that I wanted to do, which were deals that were really on the commercial and multifamily side, deals that I didn't have the financial wherewithal to do myself at that time, and to be able to use other people's money to do it. So that opened up a lot of thought processes. And then, about 2.5 years later, I wound up leaving the job full time and going full time at the syndication.
Wow. Okay. So, and that job, the job you were at previously, was that in real estate as well? Did I miss that?
It was. So it was really in a lot of different industries. There was a combination of real estate, construction, and hospitality. So it gave me exposure to a lot of different things. But the real estate
Okay.
side was always the one that I really gravitated to.
Okay, gotcha. So let's dive right in there. Let's start from the tippy top. What is multifamily syndication?
Yeah, great. So multifamily is really any residential property that has more than one unit. So if you have 2 units, it's multifamily. Syndication is a strategy that combines different people that are bringing different resources together. So the resources that you're going to see is skill, expertise, and capital. So in this case, I knew that I had the skill and the expertise to go out and find and to run these deals, but I also know I didn't have the amount of capital needed to go out and do it myself. So my need was finding somebody who had the capital, and then somebody who had the capital, but maybe they didn't have the time or the expertise, or they liked investing in these deals, but they didn't want to be actively running them on a regular basis. Then somebody like me would be a good fit for them. And what you do is you create a strategic partnership that benefits everybody, and you work to make everybody money with it.
Interesting. Okay. So it's essentially if breaking this down for a simpleton like me, if you have an opportunity on a multifamily unit, so and describing that, that would be like an apartment complex of how many units roughly or a minimum?
Yeah, great question. So even though multifamily really could be two or more units, you're probably not syndicating a two-unit deal. So most times, what I would tell people, if the purchase price of the project is less than $1 million, you're probably not syndicating it. And even that might be a little bit on the small side. For me personally, I wouldn't syndicate anything less than $2 million.
Okay. And then the act of syndicating is pulling together other people's money
Yep,
to purchase and then manage the property and then share in the profits, right?
correct. Yep.
Okay. At a very simple level. So when you first got into this, tell us about your first deal. How about that? Because when you're first jumping into something, and anybody out there listening now, they may very well be jumping into a new line of business as an entrepreneur. What was it like for you taking the leap, doing your own thing? And were you learning along the way? It sounds like you had some knowledge previously from your past work. But what were the scary parts of that? And what was that like?
Yeah, great question. So I was fortunate to have a lot of knowledge from what I did for my full time job that I was able to transfer into this. That helped a lot. The only difference, and it's a big difference, but the only difference is the guy that I worked for had his own money, so he wasn't using outside capital. I knew I was going to be needing to use outside capital. So there's definitely a lot of shifts. And I think for anybody listening who's ever went from working a job with a steady income to becoming an entrepreneur and not having a steady income, there's always some pause in your mind. You have to really think and say, okay, is this what I want to do? And the answer for me was yes. As a kid, I wanted to be a professional wrestler, but I realized I lacked the discipline in going to the gym and eating as well to do that. So when I became an adult, I knew that entrepreneurship was more my path. And I said, good news is I have the physique and the discipline for that. So
There you go.
so as I went into it, I started really asking myself, okay, do I want to leave a job that I've been at for 14 years? Do I want to give up a steady salary and have the hope that I can make something better of myself? So for me, the answer to that was yes. But it's for anybody who's ever done that and they tell you there's no fear involved, there's a good chance they're probably lying. There's always something in the back of your head that's saying, "Huh, am I making the right move?" And sometimes you never truly know until you make that leap. Uh, for me, it also involved moving to a different city. And the reason I did that is with the business I was focusing in, we were really looking to buy properties in the Southeast. I'm originally from New York. While I could have done it remotely, it would have been a lot more challenging. And I knew that for me personally, I do a lot of my best work and a lot of my best relationship building in person. So having the ability to get in front of people in the market on a regular basis would give me an advantage. And whatever market we decided on, I was going to move to. So I left the job I was at for 14 years. Totally uprooted my life, moved to a different city, started fresh. And when I moved down there, I really went sight unseen. I signed the lease to rent an apartment. I said, okay, I'm either going to sink or I'm going to swim.
Wow. Okay. Jump right in, rip the Band-Aid off.
Yeah,
So how did you find the first person or people to syndicate with? How did you get that capital?
yeah, great question. So with syndication and with most businesses that rely on capital raising, track record is extremely important. So when you're first starting out, you don't have that track record, which doesn't make you as desirable to investors. When people are putting money in you, they want to feel confident, and what helps them instill that confidence is that you've done it before. As nice as it sounds, nobody really wants to be anybody's first investor because there's a lot of risk with that. You don't know if that money's ever going to come back to you. So one of the things we do in this business is we build partnerships with people who are more experienced. And myself, I had two partners that I was working with at the time, full time building the business. And we had what they refer to as a sponsor or a key principal in the industry. And basically, that's somebody with the financial wherewithal to sign on the loan. They meet the financial requirements. And if you do a good job building relationships with those people, a lot of times they'll allow you to use their track record when you're sourcing deals and when you're finding investors. So when you're doing that at the beginning, that is a tremendous advantage because that helps you get over some of the objections and some of the hurdles you're going to hit when investors say, well, why am I going to give you my money? You haven't done this before. So
Mm.
being able to have somebody else on the team. So we had a sponsor who had owned several properties with many units. He had done this a whole bunch of times, and truthfully, he even helped us and brought in some of the capital from different people because that went a tremendous way. So the first deal and even the first couple of deals in this business are really about track record. And then after you have that track record established, then you can start relying more on your own track record to go out and attract investors.
Okay, gotcha. So how that first using your first deal as an example, what was the price point on it and how many investors did you need to acquire for it? And I'm really curious to know how those deals are structured.
Yeah. So the price point on that was 4,876,000. We had equity of about 2,150,000 in it. And off the top of my head, it was probably about 30 investors or so. Because most of the people that are putting money in these deals are investing 50 or 100,000. As much as I'd love to say everybody's investing 500,000 and a million, usually they're people putting in smaller chunks and larger numbers of investors. So the structure. What typically happens is you go out and you find the deal. Normally, you submit what's called a letter of intent, and that's done most times with real estate and with business if you're buying something that's existing. And what you're doing is you're outlining the key points of the transaction. So once that's accepted, then you negotiate a formal contract. So with this deal, we got on the contract at the beginning of June 2019. Literally about 3 or 4 days like after I uprooted my life and moved to Charlotte. So it just kind of worked out that way. Um, and what happens next is you go through all of your due diligence. So whether it's a property, whether it's business, with any transaction, there's always going to be a due diligence period where you're doing a lot of exploratory work. So you're trying to uncover all the things that the seller doesn't want you to know. and,
Hmm.
and thankfully, our due diligence turned out pretty clean on this property, so we didn't really have anything significant that was discovered that we didn't know about. So the next step then is we're going out and we're preparing to raise money. So what happens is you're normally engaging a securities attorney, and they're preparing what's called offering documents, and those are documents that you put in front of any prospective investors. So at that point, for the next 3 months from mid June 2019 till about September 5th, it was all about speaking with investors, getting in front of them, raising capital. And there's different ways that you can do it. The most common ones in real estate are what they call Reg D offerings, and there's two common ones: a 506B is in Bravo and a 506C is in Charlie. So the 506B is what we use for this one. That means there's no advertising, no marketing. It's only people with pre-existing relationships that you're putting it in front of. So they're people who you've met in some walk of life. I, Ideally, you've qualified them to make sure that investing in something like this wouldn't be detrimental to them. And then you're putting these opportunities in front of them to see if they're interested in investing with you.
Okay, so essentially, especially starting out, it's all about your network, right?
Yep.
And being able to know the people who have the money, who are willing to invest, who want to invest, and are a right fit for the group. Now, what does the structure look like when, let's say, you have? I guess what's the average number of people in on a specific property? Is it maybe 10 to 30? Is that accurate?
The answer is it really depends on the size of the property. So
Okay.
with the smallest one I've done, we had about 13 investors. The purchase price on that one was like just shy of 2.5 million. And the most investors, even though I've done larger transactions, with most investors in a single transaction, is somewhere between 75 and 80. And that one we raised about 6.7 million of equity for.
Okay. So are you and your, I guess your company, your holding company, whatever that is that the owner of the building and everybody has certain shares not to exceed your own? Is that how that works?
Not quite. So the company I run, is really just for marketing and branding. And like any
Hmm.
of the brands that I put out there, they don't really, they own very little. I mean, they do own some stuff, but very little. So each property would generally forming two LLCs. And what happens is at the very beginning, we have one LLC that's going to be taking title to the property when we close, and we have a second one that's going to be the manager of that LLC. So the manager LLC, that's going to have all the people in it who are going to be active decision makers in that particular investment. The one that takes title to the property, the manager LLC is going to be a member also. And then they're also going to have all the investors as individuals or as separate entities as they may come in, be part of that entity as well. So each of them will get a share in respect to what they contribute.
Okay, gotcha. And then you can contribute as much or as little, or I guess there's probably a minimum, but you can contribute as much as you want. Are there structures around how and what you can contribute?
Great question. So the answer is it varies from deal to deal. There are some deals where they actually do set a maximum amount as well. For me personally, I haven't done that yet. It's a problem that I'd like to get to, but I haven't hit that level. So when you have so many people who want to invest with you that you can afford to be more selective and start turning some away, that's a good thing to have. And sometimes you will see larger, more experienced syndicators set a maximum because they want to limit that. But for me, I don't usually do that in my offerings.
Okay. So what about management of the properties? It's one thing to invest in and to buy or manage the investors of a property that's bought. How do you have like management company that handles all the properties, or is that, what does that look like?
Yeah, great question. So in most cases, we're using third-party property management. So what that means is we're taking a property management company who's unaffiliated with us, and we're hiring them to oversee operations of the property. Now, what happens with a lot of these deals is so there's property management and there's asset management. So property management is managing day-to-day operations. What that's doing is it's taking, leasing, collections, all the basic functions at the property level and working to get those in harmony and working together. Asset management is really tracking the dollars and tracking the overall business plan. So it's tracking, okay, how is the money being spent? Where are the dollars going? And the premise that these deals are generally built on is that usually after a certain period of time, you got to be paying out periodic cash flow distributions to the investors. It's one of the reasons they invest in these deals. So you want to make sure that you have enough cash to do that and keeping an eye on where the money's going and just making sure. So there's a lot of time involved in management as well. If you're going to be on the active side of these deals, because while the management companies can do the basics, they often lack the foresight to really think things through and kind of figure out the bigger picture. So you need to stay on top of them on a regular basis to make sure those goals and those objectives are being hit.
Hmm. Is investing in something like this, is this a sure thing, or is there? Tell me about the risk side of all this.
Yeah. So the first thing I would always say with anything, if ever you hear the word sure thing or guaranteed investing, I would run as far the other way as you could. So definitely not a sure thing. And, for a couple of years, I think a lot of people thought these were a sure thing until they invested in deals in 2021 and 2022. And now, unfortunately, some of those aren't panning out as well as people had hoped.
Hmm.
So I think like any investment, there's definitely risk. And there's a lot of risk, but there's also opportunities. And the risk that you have in these deals, for somebody who's passive, legally, they have no decision-making ability. So that's not going to be the right fit for everybody. I know some people who they want to have complete control over their investments, and I know others who they want to set it and forget it. So for somebody who wants to set and forget, these are good opportunities. For somebody who wants to have it set, this isn't the right fit. Um, the risk a lot of times there's market risk. So the reason a lot of those deals in 2021 and 2022 aren't performing so well is because it's always clear in hindsight, but we now know that a lot of those properties were purchased at the top of the market cycle. So because of that, a lot of them are worth less in value now than they were 3 or 4 years ago. And because of that, a lot of people may have money lost in those situations. So there's market risk. There's operator risk. So if you wind up investing in a deal that you're passive in and the operator doesn't perform, or worse yet, the operator goes totally silent and disappears, which unfortunately does happen in some cases, then that's a risk. Now, there's a lot of opportunities where deals go well, so let me not make it sound all negative because that's not the case. But with any
Hmm.
investment, there is risk for sure.
Okay. So I guess how many deals a year do you do, or does your company handle? And like I want to know what the possibilities are with going into a business like this.
Yeah. So right now, for me personally, in the last nearly 6 years that I've been doing this full time, I've been involved in 11 deals as an operator. Uh, Now, what I would say is, well, that's definitely more than some. It's a lot less than others. So I think with everybody, you have to go at your own speed based on the tools that you have available to you. There's groups I've seen that have bought 57 properties in that same time. So you can definitely go a lot faster and a lot bigger, but you need to have more bandwidth. So
Hmm.
depending on the capital you have to start out with, depending on the ability you have to attract new capital to you, those are things that are very important when you're trying to scale faster.
And is this something that someone or a team, a full business doing this, they could take this, do it remote? Like you could have properties across the country, or is this something that's much more easier to dominate a certain city or region or market?
Great question. So the answer is you can do it both ways. Um, Now, for me personally, I'm probably a fan of being more hands-on than most. It's rare that I'm hands-off with anything, so I probably wouldn't make a good passive investor. Uh, but I think there is a benefit, especially in something that's as localized as real estate, to having a local presence. If you're if you're in the financial position, or if you have a company that's large enough to afford full-time staff, it doesn't necessarily need to be you, but you need somebody who's going to take accountability and ownership of that. And whether it's having an office or a team in a region, that's going to be very important. So, like if I was in New York and if I was trying to run a property in New Mexico, would that work very effectively? Probably not. Now, if I had the wherewithal to have boots on the ground there and to be getting oversight on it, that could potentially be done and work well. You just need to have infrastructure there. So it doesn't need to be you personally. You could be remote, but you have to be in a position to have the right infrastructure and the right people there overseeing it for you.
Okay, gotcha. So what's your day to day look like, especially in multifamily syndication, like in the type of business you're running? What's your day look like, and I guess how passive or not passive is this venture?
Yeah, great question. So my day is usually a mix at this point of speaking with lenders, investors, property managers, and also looking for new deals. So it's kind of a hybrid of those two. So we have, of the 11 that I've been in, we sold six of them. There's five that I'm still in. So there's a good amount of time that's devoted to the five that I'm in because I'm overseeing, financials, speaking with property management companies, just keeping an eye on them pretty regularly and seeing what we can do to improve performance. And then it's also on the flip side looking for new deals. So most of the deals I get come from real estate brokers. There are some I get that come from direct from sellers as well, but most from brokers. And working through them to see how we can figure out a path that makes sense on them. So you could do it totally passively, but again, that depends on having enough scale or enough financial wherewithal to go out and put people in place to do that. So, like if you were just starting out and you didn't have a lot of money, I think you'll need to have the expectation that there's going to be a serious time commitment.
Right, right. Okay. What does the competition look like in this? Like if there's like it sounds like, you're not buying like a property a week here, obviously. So when you do see an opportunity, a building comes up or you hear about it from a broker, is it like a mad dash from other companies, other players like you? Or is this kind of like pretty, the lower competition, I guess I should say?
So multifamily is very high competition. Um, 10 to 15 years ago, it probably would have been a different narrative, and I think you would have seen a lot less competition. But a lot's changed in that time. I think we've seen capital raising become a lot more popular than it was 20 years ago. 20 years ago, while the internet was around, you weren't seeing a lot of people use it to go out and attract people to them or to raise capital. So it was limited more to big institutions, high net worth individuals. Now it's a lot more open to the general public than it was 10 years ago. So because of that, and also a proliferation of different people who are teaching how to invest and how to run these deals, you've seen an increase in competition over that time. Now, the good news is that over the last 3 years, some of that competition has been weeded out just because market conditions have changed. There are definitely people that have exited the business. So Competition, I would say, is still high in comparison to most other things that you're going to be looking to buy into or start up in, but it's a lot less than it was 3 years ago.
What can make a deal go wrong or go bad? How do you know if this is going to be a good investment? And do you have any stories about things that you found or discovered that made a deal turn sour, hopefully before it was closed?
Yeah. Well, unfortunately, not before it's closed, but
Oh, okay.
so thankfully, there's one deal that we did actually have in the contract that we didn't close, and the reason for that is because during our due diligence, we found that the property was an 80 unit property in Charlotte, and it had a lot of money spent on it, and we were under the impression, based on questions we had asked and even tours we had of the property before going on the contract, that although most of the units were upgraded and looked like the ones that we saw during the tour, what we found during the due diligence inspection when we walked all of the units is that wasn't the case. There was a lot
Mm.
of money put into the property, but it was really put in one or two buildings that had a fire and not spread throughout the property like we were told. So what that meant is we would have had to spend a lot more money on those other buildings to get them up to the condition we were expecting. And that would have totally killed our returns on our business plan. So that we chose to back out of because we said it just doesn't make sense. There's no way we're going to be able to pay this price. I need to bring all this additional capital and still have the returns make sense. So on the front end, a lot of times what you want to do is you want to use reasonable assumptions for rent growth and expense growth based on market conditions. A lot of these deals are usually modeled with like a 3 to 5 year hold. And with the groups that are looking at them, the reason for that is because the investors in these deals generally want their money back at some point. Psychologically, I think people are okay tying their money up for a 3 to 5 year period. A lot of them start having serious doubts when it's going to be longer than that. Because then, even if the deal is doing well, it's just something psychological about seeing their money come back to them. People like it.
Right. So you mentioned, when the deal goes well, what type of returns, or I guess when an investor invests in multifamily syndication, what are their expectations on return?
So, an expectation, and again, it will vary from deal to deal, but a range that you can generally expect is somewhere in the 15 to 20% range per year. Now, when I give that range, that's a combination of both cash flow and the sale proceeds in the future. So with the cash flow, a lot of times it's reasonable to expect somewhere in you know the 6 to 8% range historically. I would say that number is probably a little bit less in the last 2 years, just because cash flow has been a lot tougher to come by, unfortunately. Uh, and then the rest of that 15 to 20% coming on the backside.
Okay, gotcha. So how do you know, or I guess who decides when to sell, or
Yeah.
if you need
So
to, or if you want to?
So with any of these deals, what's going to happen is they're going to have a manager or a handful of managers that are responsible for the decision making. So they're going to be responsible for keeping an eye on the market. They're going to be responsible for assessing where the property is and to see if it makes sense to sell. And there's all different reasons you could sell. Sometimes just because you've executed your business plan and you believe you can get the number you want, so you put it out there to the market and see if there's a buyer. Sometimes just because the market is white hot and you have a ton of buyers. So for anybody who was selling deals in 2021, they probably were very happy with the result. There was a ton of buyers out there. They were paying crazy prices. So even if they weren't thinking of selling at the beginning of the year, there's a good chance they may have had that thought as the year went on and said, wow, maybe it's time to sell. Uh, Sometimes it could be, unfortunately, because deals aren't going well. And maybe they realize that even with the diligence you did on the front end, that some things just aren't working as well as you expected, and there's an opportunity to get out. Sometimes just because the property ran out of capital and you can't afford to operate the property, so now it's very challenging, and you don't want it to become distressed or more distressed. So there's both good and bad reasons to sell, but I think it's keeping an eye on the overall market conditions, the property's financial position, and the property's operational performance to really figure out when that right time is.
Is what would cause a revenue problem, I imagine, is not renting enough of the units.
That's a big one.
Yeah, that makes far too much sense, doesn't it?
Yeah.
But what, especially in this day, it feels like at least around me, like every unit everywhere is like booked up and it's going for top dollar. I don't know if that's the same in every city across the country, of course, but is that, I guess that's part of the due diligence at the beginning, is making sure that you can get it rented, or if it's presuming it's an existing building, you already have rental data, right?
Yep.
Like what would cause a building to start being less rented or rentable, I guess.
Yeah, great question. So the biggest changes there would either be change in market conditions or change in management, and those are usually the two factors that would cause things to change. So now real estate's very hyper local, right? So what you see in New York is going to be very different than Charlotte. It's going to be very different than what you see in Indianapolis. So every market's going to be a little bit different and have their own their own nuances. Um, So, for instance, a lot of the Midwestern markets generally held up pretty well. Occupancy stood pretty steady. Collections didn't have much of an issue. The Sun Belt region, which is kind of like from Virginia to Arizona, pretty much the entire southeastern and really the entire southern portion of the U.S., uh, that had a lot of challenges the past couple of years. And the biggest reason for that is because there was a lot of new supply. So, as supply was really hitting the market and a lot of supply in a short period of time, that put a lot of pressure on occupancy rates throughout the industry. And what happened is it led vacancy to go up because people had more options to choose from. Now, the good news is in 2024, there was a tremendous amount of absorption, which is probably better than people expected. It happened a lot faster. But even as much as absorbed, it just didn't keep up with as much as came on the market. So more and more supply kept coming online. That's continuing to happen through the first and second quarters of this year. And then after that, it kind of falls off a cliff with new deliveries for a while. So at that point, the market will start to catch up. And as the market catches up and the units absorb, then you have the opportunity to keep vacancy rates lower and to keep rents higher.
Gotcha. Yeah, I feel like anytime I'm driving through down south somewhere, there's cranes everywhere, and it's it's new residential going up. They're not building office buildings, so
Right.
it seems like there's always something new going in.
Yep.
Speaking of new, do you guys do you invest in like new buildings, or is this only existing buildings?
So we do all existing, but there are definitely groups out there that do new as well. For me personally, I think development can be very lucrative, but it's not something I have a ton of expertise in. So one thing that generally helps with these is you want to find whatever that niche is where you have a competitive advantage and work in that. It doesn't mean that you can't explore and expand into different things, but you want to make sure you have somebody on your team who really has a good understanding of that niche.
Gotcha. Now, I remember at the beginning, I think you said something about how it really makes sense that if the properties are, $1 million, $2 million plus, is this multifamily syndication? Is this something you could do at a micro level? Where let's say you buy I don't know, a 15 unit apartment building in your Midwestern town or your Southern town, wherever you are. And then you find a couple investors, whether they're friends or network people or what. Is this viable on smaller properties, or is that just more of your preference that it makes more sense having more money in the deal on a more expensive and bigger property?
So it is viable, but in most instances it won't make sense. Um, what's probably a more viable option is what they refer to as like a JV. So maybe you find two or three people that have some money, could be friends or relatives or even people you meet at events, but preferably people that you actually know and have some type of history and relationship with. Um, so if you're buying let's call it a 500 or a $700,000 property, could you syndicate it? Yes, but there's two things I would say. One is that the legal cost associated with preparing those offering docs can be pretty steep on a deal that size, so a lot of times it's not worth it. And the second thing is there's also an extra layer of responsibility that comes because when somebody's investing passively from a legal standpoint, you now have a fiduciary responsibility to them. And because of that, that changes the transaction. So it's not just a real estate transaction, now it's also a securities transaction. So there's all different laws and different rules that apply. Where if you keep it just like two or three people coming in, everybody at least legally can be active. Then at that point, you don't have that same level of risk or that same cost on the legal side.
Okay, gotcha. Well, as we start rounding it out here, my one of my last questions here is if there's somebody out there listening who finds this to be very interesting, what would be the top few things you would recommend they do to take steps towards getting into this industry?
So first thing I would tell you is network, and I think regardless of what the industry is, whether it's multifamily, whether it's raising capital for anything else, or any industry, you got to find out what rooms you need to be in. And the rooms that you need to be in when you're first starting out are going to change as you become a little more mature in that space. So always keep growing and keep learning. But if you're starting out, figure out what rooms you need to be in and start getting in those rooms. The second thing I would tell you is to be a sponge. Learn as much as you can, absorb the information, whether it's through YouTube videos, through podcasts, through books. Find anything you can that's going to help you gain perspective and knowledge. And then what you can do is after you have some of that, you can start forming your own opinion on it and developing things that work for you.
Okay, awesome. Awesome. Well, perfect. Well, Charles, I need to let you get going. You're a busy man, but if we have any listeners out there who want to follow you, get in contact with you, or check out what you're doing or learn more, what's the best way for them to do that?
Yes, let me give you two ways. I'll give you phone and email. So phone is 347-306-3278. And email is Seaman, C like Charles, Seaman, Seaman at masterpassiveincome.com.
All right. Awesome. Well, Charles, thank you so much for sharing your time and knowledge with us.
Likewise, thanks, Brien, for having me.
All right.